Good morning, good afternoon, and good evening. Whatever time you're listening to this, please welcome to the Market Color Podcast. This is a weekly podcast that is dedicated to providing our listeners with a broad overview of the global financial markets, including a special focus on the Kenyan markets. And in order to deliver on this objective, we have structured this podcast to begin with an overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 131, and in this episode we are reviewing the performance of the global markets during the 43rd week of 2024, and that is from Monday the 21st to Friday the 25th of October. And without further ado, this is your host Jamuhuri, and together, let's dive right in. We kick it off on the global scene where, according to the International Monetary Fund, most countries have managed to lower the rate of inflation and at the same time avoided an economic recession due to higher interest rates. Despite that, the global economy still faces escalating geopolitical risks and the prospect of weaker economic growth in the medium to longer term. The IMF released its World Economic Outlook on Tuesday, in which it projects that global headline inflation will fall to 3.5% by the end of 2025, down from an average of 5.8% in 2024. According to the outlook, inflation peaked at an annual rate of 9.4% in the third quarter of 2022. Even though the global battle against inflation is almost won, the IMF remains cautious and has called for a triple policy pivot that will address interest rates, government spending, as well as reforms and investment to boost productivity. Meanwhile, in the United States, recent price reports indicate that the rate of inflation over the past 1 year has been slowing down towards the Federal Reserve's target rate of 2%. However, continued progress towards the target rate is not guaranteed, which is why the Federal Reserve must remain vigilant and intentional. When it comes to inflation, there are two things to note. The first is the annual rate of inflation, which is released on a monthly basis and is what policymakers and investors are focused on to determine the future direction of interest rates. The second aspect of inflation, which unfortunately does not receive much attention, is the cumulative effects of inflation, which tends to impact consumers negatively as the prices of goods and services continues to increase beyond the 12-month measurement period and can have drastic consequences on the cost of living, especially where wages and salaries are not increasing in tandem. The annual rate of inflation in the United States was recorded at 2.4% in September, which was a vast improvement over the 9.1% top in June 2022. Inflation fast surpassed the Fed's 2% target rate in March 2021 and was initially dismissed by Fed officials as being transitory. However, that was not the case as inflation has remained sticky until recently. Moving over to China, On Monday, the People's Bank of China announced that it had lowered its benchmark lending rate by 25 basis points. The one-year loan prime rate was cut to 3.1%, whilst the five-year loan prime rate was trimmed to 3.6%. The reduction in interest rates was expected as China's central bank governor had indicated on Friday that the loan prime benchmark rate would be lowered by about 20 to 25 basis points. For your information, the one-year loan prime rate influences the rate of personal and corporate loans in China, whilst the five-year rate serves as a benchmark for mortgage rates in the country. And whilst China was cutting, Russia, on the other hand, was raising interest rates, as on Friday, Russia's central bank raised its key interest rate by 200 basis points from 19% to 21%. The central bank cited the considerable increase in consumer prices and the prospect of higher inflation in the medium term. According to Reuters, the hike of 200 basis points exceeded analyst expectations for an increase of 100 basis points and brings the institution's benchmark interest rate to its highest level since February 2003. On Wall Street this past week, tech stocks boosted the market ahead of the upcoming earnings season as the Nasdaq Composite rose to an all-time high on Friday. The tech-heavy index rose 0.56% to 18,518, whilst the S&P 500 was marginally lower by just 0.03% to close at 5,808. And the Dow Jones Industrial Average shed about 260 points to end the session at 42,114. The Nasdaq recorded its seventh weekly gain as it advanced nearly 0.2% for the week, whilst the S&P 500 and the Dow Jones both snapped their six-winning streak as the broad market index declined by nearly 1% for the week, whilst the 30-stock Dow fell by 2.7% during the same period. In the U.S. government bond market players have been monitoring comments by Federal Reserve policymakers and reflecting on September's 50 basis point rate cut and its impact on the potential path for future monetary policy. Focus was on the 10-year Treasury bond after it hit a three-month high of 4.25% on Wednesday. The yield on the benchmark 10-year Treasury bond closed the week at 4.24%, whilst the yield on the policy-sensitive 2-year Treasury note was higher by nearly 4 basis points to end the session at 4.105%. According to the CME's Fed Watch tool, the 30-day Fed funds trading puts a 97% probability that the Federal Reserve will cut interest rates by at least 25 basis points at its November policy meeting. For your information, bond yields move inversely to bond prices, and 1 basis point is equal to 0.01%. In the commodity market, the price of crude oil posted a weekly gain of 4%, with investors taking stock of the ongoing conflict in the Middle East, as well as the U.S. presidential elections on the 5th of November. Geopolitical risk is the leading force in the market today, with investors globally piling into the U.S. dollar and betting on increased volatility ahead of the upcoming U.S. elections. The price of the global benchmark Brent crude rose by 2.25% to close at $76.05 a barrel, whilst the price of the U.S. benchmark West Texas Intermediate crude was up by 2.27% to finally settle at $71.78 per barrel. For the week, Brent posted a gain of about 4%, whilst US crude was higher by about 3.7%. In the precious metals market, the price of gold edged up on Friday after recovering from a bout of profit-taking as tensions in the Middle East and the uncertainty about the upcoming US presidential elections both supported the price of bullion. The price of gold has risen over 32% so far this year, driven mainly by safe haven demand due to the ongoing tensions in the Middle East and supported along by a 50 basis point rate cut by the Federal Reserve and the prospect of further rate cuts as inflation continues to fall. The price of spot gold hit a record high of $2,758 on Wednesday and logged a third straight week of gains as it eventually came to a close at $2,743 per ounce. We now change scene to the Kenyan financial market, and we start by looking at the domestic foreign exchange market, where during the past week the shilling remained flat versus the US dollar, and according to data obtained from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at 129.20. Meanwhile, the sterling pound was priced at 167.02 and the euro was valued at 139.41. And on the regional front, one Kenyan shilling was changing hands for 28.38 Ugandan shillings and 21.09 Tanzanian shillings, and to the Rwandese franc, it was posted at 10.46. The dollar-shilling exchange rate has now been trading at the same level of 129.20 for the past around 3 to 4 weeks. This is not normal for a currency to trade at the exact same level for such a long duration unless it has adopted a fixed exchange rate policy or the central bank is artificially managing the exchange rate. In this case, I think the latter is true. And this is evidenced by the country's excessive national debt, which now stands at above 70% of the gross domestic product and consumes about 60% of total tax revenues. On foreign exchange reserves, Kenya's usable foreign exchange reserves decreased marginally by $6 million, but remained adequate at $8.485 billion, which is equivalent to 4.4 months of import cover. This level of reserves is now in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. Kenya's foreign exchange reserves remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports, and is further exacerbated by our ever-increasing external debt repayments that has pushed the country to the precipice of a sovereign debt default. On diaspora remittances, the inflow of remittances in the month of September 2024 totaled to $418 million, compared to $340 million in September 2023, which was an increase of about 23%. The cumulative inflows for the 12 months to September 2024 increased by 14% to $4.72 billion, compared to $4.14 billion for a similar period in 2023. The inflow of remittances continues to support Kenya's current account as well as the domestic foreign exchange market. The United States remains the largest source of remittances into Kenya, accounting for about 55% of total remittances received in September 2024. In the money markets, during the past week, the interbank market was sufficiently liquid and was also supported through open market operations. Open market operations refers to the purchase and sale of government securities by the central bank in order to regulate the supply and credit in the economy. The interbank rate, which is the rate that banks lend to each other on an overnight basis, this increased marginally by 4 basis points from 11.93% that was recorded the previous week to 11.97%. And in terms of volume, the average value that was traded in the interbank market increased from 41.5 billion shillings the previous week to 44.4 billion shillings. Meanwhile, the excess reserves held by commercial banks in relation to the 4.25% cash reserve requirement, this stood at 17.8 billion shillings. For your information, the cash reserve is a statutory requirement that specifies a percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 24th of October, and the central bank received bids totaling 85.75 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of about 357%. The central bank ended up accepting only 41.75 billion shillings, and the results of the auction were as follows. The 91-day rate fell by about 33 basis points to average out at 14.43%, whilst the 182-day rate dropped by about 49 basis points to close out at 15.14%, and the 364-day rate declined by 44 basis points to eventually settle at 15.46%. In the primary bond market, the Central Bank of Kenya has published its prospectus for the November bond issue and is looking to raise a total of 45 billion shillings for the stated purpose of budgetary support. The central bank is inviting bids for the following bonds, whose terms and conditions are as follows. The first bond is FXD1/2023/10 with 8.3 years left to maturity and a coupon rate at 14.15%. The second bond is FXD1/2022/15 with 12.5 years left to maturity and a coupon rate at 13.94%. And the third bond is FXD1/2024/10 with 9.4 years left to maturity and a coupon rate at 16% flat. Please note that all these bonds are now open for sale, but the first two bonds are only open until Wednesday, the 6th of November, and their value date is Monday, the 11th of November. Meanwhile, the third bond is open for sale until Wednesday, the 13th of November, and its value date is Monday, the 18th of November. In the international markets, during the week, the yields on Kenya's Eurobonds were on an upward trajectory, with the yield on the 12-year 2019 Eurobond increasing the most by about 30 basis points, as it rose from 9.8% recorded the previous week to 10.10%. At the Nairobi Securities Exchange, during the week, the equities market recorded a mixed performance, with the NASI gaining by 0.8%, whilst the NSE 10, the NSE 20, and the NSE 25 declined by 0.8%, 0.4%, and 0.3% respectively. This takes the year-to-date performance to gains of 33.4% for the NSE 10, 31.2% for the NSE 25, 25.6% for the NASI, and 22.9% for the NSE 20. The market's performance was mainly driven by gains recorded by large cap stocks such as Bamburi Cement, DTB Bank, and Safaricom, which increased by 17.4%, 5.4%, and 4.1% respectively. These gains were, however, weighed down by losses recorded by other large cap stocks such as East African Breweries, KCB Group, and Equity Group, which declined by 4.7%, 3.8%, and 1.2% respectively. And in related news, during the week, the Capital Markets Authority approved a rights issue for HF Group, formerly known as Housing Finance, and in the process facilitated a significant capital raising initiative that is aimed at strengthening the bank's balance sheet and supporting its strategic growth objectives. The HF rights issue involves the issuance of up to 1.1 billion new ordinary shares that are priced at 4 shillings each, with a par value of 5 shillings per share. Up next is our topical issue, and this week we are looking at the currency printing tender awarded to a German firm by the central bank. The Office of the Auditor General has flagged anomalies in the currency printing tender for 14.5 billion shillings, which the Central Bank of Kenya secretly awarded to a German firm. In April this year, the Central Bank awarded a 5-year deal worth 14 billion shillings to a German firm to print new currency notes for the country. The Auditor General noted that the Central Bank failed to appoint a special committee to guide the search for the currency printer of new banknotes. The appointment of the special committee, composed of both central bank insiders and outsiders, was meant to eliminate collusion, insider dealings, and fixing of higher prices in the absence of competitive bidding, which would have helped to deliver the best deal at the lowest price. The central bank said the German firm was picked through a classified procurement process on the back of an eminent stockout of banknotes, which would have had grave consequences and security implications for the country. The central bank was initially unwilling to divulge the details of the currency printing deal, and this information was only made available after Parliament's Finance and National Planning Committee compelled the central bank governor to reveal the name of the German firm and the cost to Kenyan taxpayers. The Auditor General says that the central bank breached Regulation 84 of the Public Procurement and Asset Disposal Regulations of 2022, which demands that a special committee be appointed to guide the procurement of classified goods and services. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if so, please share it with a friend and help to spread the word around. I really do appreciate your assistance in this effort. And for your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major hosting directories, that is Apple Podcasts, Spotify, and Amazon Music. Please consider subscribing so that you can be notified every time I publish a new episode. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address. That is jamuhurij@gmail.com. Jamuhuri spelled Jamuhuri. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourselves a blessed and fantastic week ahead. And remember, if you bring forth what is within you, what you bring forth will save you. But if you do not bring forth what is within you, what you do not bring forth will destroy you. Think about it. Thank you, and God bless.